Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Are you based in Minnesota right now? Where are you based?
Yeah, we're based in Minneapolis, Minnesota, right close to downtown Minneapolis. How about you guys?
New York. Van Eck is headquartered in New York. We have an office in Tampa, in some outposts around the world, in Europe, Australia, and China. Most of our team's here in New York.
Awesome. Yeah, my wife and I planned to move to New York before the pandemic hit, and I guess somewhat glad that we didn't, with all would have been difficult transition to New York in the middle of the pandemic, but still long-term goal to get there. My wife just loves New York, and it's a dream of hers to live there someday.
Well, I could tell you some horror stories about New York during the pandemic. I stayed here throughout when everybody else left. I wish I left and perhaps had a place out in Lake Minnetonka during the summer. I love that place.
Yeah, that is. I have some family not too far from there. It's a really beautiful spot to get away in the summer. And Minnesota is a summer destination, but winter it's pretty bleak out here.
Yeah. Welcome to another episode of Trends with Benefits. My guest today is Luke Wilcox. He is the CEO and founder of Ethos ESG, which is a fintech platform designed to align your money with the causes you care about. Things like racial justice, climate change, LGBTQ equality, and more. I think he's on the cutting edge of a new thread in the ESG story, and that being impact. As people start to wake up and really understand what they are looking for and demanding of their investments, impact is becoming a more important story within this space. And it comes at a particular time when concerns and criticisms of the typical ESG rating systems continue to get louder and louder. But first off, Luke, welcome to Trends with Benefits.
Thanks, Ed. It's great to be here. I appreciate you having me on today. Excited to talk about Tesla and all this exciting developments in ESG and impact.
I think your company is really interested in the fact that you are focusing on aligning people's money with their values and the idea of trying to assess impact and letting people invest for impact. And we'll get into all of that. But saw a headline today, Tesla has gotten booted out of the S&P 500 ESG Index. And I love this for so many different reasons. And there's differing opinions on each side of the story. But what does that tell you, or what do you think about that news today?
Yeah, it's really not surprising. ESG has historically really focused on risk. For those who aren't aware of the ESG story or history, it's really about mitigating risk related to environmental, social, or governance factors that a company might be involved in. And from a risk perspective, the exclusion of Tesla may make sense. They've obviously been in the news a ton. Elon Musk has been in the news a ton. Tesla has had a lot of controversies related to the S and the G part of ESG. So some racial pay disparities, some other controversies that they've been involved in. So from a pure risk perspective, that may make sense. That's what ESG has been about historically. For most investors who think about ESG, they think about more of the impact side. And that's what we try to do, is look at more of the impact side. And from an impact perspective, it really strikes people really strangely that Tesla would be excluded from anything related to impact or environmental impact. If you look at the core business model, how Tesla has had a really dramatic impact on the car industry and moving that away from fossil fuels, that's a pretty tremendous impact just at face value that everyone, I think, recognizes. So it's really that disparity between the traditional risk versus the growing part of ESG that focuses on impact. And yeah, I think something that I would advocate for is just this ongoing move towards impact. I think all investors are increasingly interested in what is their impact of their money.
Yeah. And it's an interesting story as well, just from an index construction standpoint, because we're talking about the S&P or Standard & Poor's and their rating system. And it seems like they built their index to provide similar exposure to the S&P 500 in terms of their sector exposure. And so it's kind of Tesla's rating fell on a relative basis to other companies in their industry. And that just kind of makes it just kind of going by the rules, you know, and Elon's out there tweeting about, hey, Exxon is ranked higher than us, but really it was kind of more about their relative position in the industry.
Yeah, that's a great point. An index is going to, as you said, have sector weights and try to maintain that sector allocation. So it is a good point that Exxon within the oil and gas part of the S&P 500 index is maybe better than its peers. And I know that they are much better on some of the S and the G components. So some of their metrics in those areas are better than peers. And they may be doing more than some large peers on some of the transition to clean energy potentially. But that's really a relative scoring. Whereas if you look across sectors, then obviously I think in most people's eyes, Tesla and a lot of other companies should be ranked higher than someone like Exxon from a pure environmental impact perspective. But from an index construction, yeah, it's a nuance that is easy to look past or get lost in the face value of Exxon being ranked higher than Tesla just doesn't make face value sense.
Yeah. And to further to that point, it was interesting. A colleague of mine shared with me that I think it's Sustainalytics that Morningstar uses. Actually, Tesla was ranked, I guess their ESG risk was high risk at one point, but now they're medium risk. So they've actually come down on their ranking system, which I thought was really interesting. So it really kind of depends on what ranking system you want to look at. I guess my message to people on that is, you know, understand what you're buying in terms of a fund or ETF, understand the methodology. There's going to be differences.
Yeah, definitely. And an increasing number of ETFs or funds will look at ESG, or they'll look very explicitly at impact or trying to have more of an impact. They try to distinguish between those two. Whatever ESG ratings or risk provider you're looking at, yes, it's very important to understand their methodology, at least at a high level, if it's looking more at risk or impact. One big criteria there, if you're comparing ratings or different analyses of any fund or company, looking at, so what metrics are they using? Are they using carbon emissions, environmental fines, clean energy contribution for metrics they're using? And then two, how are they weighting those different metrics? If you want to get into the weeds, there's a lot of detail there about the difference between Sustainalytics and MSCI and other major providers, often driven by weightings, by how they define which metrics to use. And then a third factor would be what industries do they map to specific metrics. So oil and gas, for example, is going to overweight things like clean energy, the transition, as well as carbon emissions, whereas a social, more of a software company, for example, is going to overweight social causes. So it's also important to look at how ESG ratings providers look at specific industries differently.
And then just to kind of finish the discussion on Tesla a little bit, looking at your own website, you guys rate Tesla overall based on impact with a score of 86. Is that a good score?
Yeah, it's 86 out of 100, so it is a really good score. And we've really defined the material or important causes for the auto industry as very heavily weighted towards clean energy and reducing GHG emissions, and that we've defined very heavily weighted towards that impact. So someone like Tesla, which is driving that transition, gets rated very well for this overall impact score. I also want to note that we show the distribution of impact. So if you as an investor only care about social issues, or that's most important to you, for example, you can still see on Ethos and elsewhere that Tesla performs and rates poorly on things like racial justice or treatment of workers. So if you want to focus on those issues, you can still do that. Ethos, our perspective is for the overall impact score to really focus on where that industry is having the most effect or impact.
Let's take a step back and talk about the growth of ESG, and we'll build up to the launch of Ethos. But ESG has exploded over the last few years. Looking at a report from or an article from the FT using data from Morningstar, they noted that ESG funds took in total assets of $2.7 trillion at the end of 2021, and that was triple the figure at the end of 2019. What do you think has contributed to the growth of ESG?
Yeah, a few things. One, it's much more tangible to people from a pure ESG risk perspective. There are many more risks that have arisen, I would say, or that have become more clear and present to people, from climate change impact and the very tangible things like forest fires and increased climate events, to more social justice movements, and that from a pure risk perspective, seeing that as an increased risk to corporate performance. But two, those same tangible events and changes are really driving a tremendous growth in the end investor interest in the impact side of investing. So a tremendous increase in just wanting to align your money or your investments with things that are important to you personally as an investor. That's I think a lot of studies out there show that millennials, as well as really all ages of investors, have an increased interest in understanding the impact of their investments and aligning money with their values. And that sort of trickles up to funds, to investment managers. And when they think about developing an ETF or a product, they're thinking about the investors, either institutional investors or retail investors, and what those investors want. So it's driven by these large-scale events that are and changing consumer and retail investor preferences that are trickling up to fund managers and others. It's also become much more prevalent in in C-suite boardrooms among corporations as just a tremendous risk that corporations see and want to start addressing as well.
You said tremendous risk, and you're referring to like ESG risk that they're seeing?
Yeah, a lot of C-suite or boardrooms or a lot of corporations see increased risk from climate events, from this growing awareness and growing info that's out there for everyday consumers, for investors, for their customers. It's a lot of transparent information that's available, more accessible information about corporate behavior, about controversies, impact on climate change. That is, I would say, sort of an overall trend that corporations are having to consider. What is the impact of their activities of their business on climate change, on social justice, due to the increased awareness and interest among their customers and consumers?
From a traditional rating standpoint, I think a lot of those look at companies from a financial risk standpoint, don't they? When they're looking at ESG, such as their exposure or a potential liability with regards to social issues or governance issues, even climate issues, or perhaps the environmental impact that they may have as well. So that there's interest, in the C-suites, obviously, with regards to the financial materiality of some of those exposures. But then there also seems to be this underlying investor demand. That do you think that the boards are feeling that heat from investors?
Yeah, I do think so. From both the largest investors all the way down to retail investors, I think they are feeling more heat from fund managers themselves, who are often very large investors in corporations. They're feeling the heat from their stakeholders, demand from their own stakeholders to have more of a ESG perspective in all of their fund products and their investments. We see that from someone like BlackRock. So Larry Fink, the CEO of BlackRock, has made a lot of public statements about how BlackRock is shifting to incorporate more ESG factors into its investment process and its the companies that it decides to invest in. That is a very public example, but I think there are many other instances where fund managers are incorporating more ESG, and ultimately driven by this broad increased interest in impact and in incorporating more ESG factors, and people being scared of climate change and wanting to have an impact on social justice. That really trickles up to fund managers and also just creates more risk that fund managers need to account for.
In terms of some of the real world factors, driving the growth of ESG, I get the increasing incidence of, wildfires and climate anomalies, things of that sort. How does something like the Russia-Ukraine conflict weigh into the ESG story?
Yeah, it's a great question. It's driven a lot of interest towards investments in Russia, or any investments in companies or funds that would have a tie to that. So it's looking at that link between your investment and any impact on political activity, or it's hard to make a direct tie between investing in a fund that holds a Russian company, for example, and any impact on the Russia-Ukraine war, for example. But it is similar to other screens in ESG, where you want to exclude fossil fuel or exclude gambling or some other criteria from your portfolio. A lot of investors now say, I am very appalled by Russia's invasion of Ukraine. I don't want to be supporting any Russian company or any international company that invests in Russia, that is active in Russia, supporting Russia in some way. It's wanting to align your money with things that are important to you, the same broad trend of aligning money with values. Just going into this political arena, and it's hard to tie a direct link, but it's similar to voting, where if enough people exclude their capital from supporting companies that are involved in Russia, for example, and that's going to have a aggregate effect at some point where it's those companies will feel the pressure to companies who have not left Russia, for example, or are still involved in Russia, will feel increased pressure to change their business model, or change their process there, and maybe leave Russia or change their activity there.
How have you seen the landscape change in terms of investment products associated with ESG? How has that changed over the years?
Yeah, I think it's followed the overall tremendous growth of ESG, where there's been, I'm not sure the numbers off the top of my head, but a significant uptick in ESG ETFs and mutual funds. Other investment products have really grown tremendously. And I would say the impact products that take a more explicit look at having a positive impact on climate action or clean energy or the UN development goals, those have also grown pretty tremendously the last few years, just driven by the same end investor interests in impact. And one other trend with that is that increasing demand for personalized products. So there are a lot of fund products that are like a broad ESG or broad impact or broad climate focus, but there aren't that many products yet that look at a very personalized approach to, I as an investor care about X, Y, and Z issues, and I want a tailored set of ratings or tailored product that has the best possible impact on those sets of causes. That I see that as a growing trend. Something that Ethos we try to do is enable that personalized product development, but definitely see that as a growing interest.
So let's talk a little bit about the criticisms and the growing number of voices talking about ESG and the potential, headwinds, drawbacks, whatever you want to call it. And what's your take on the increase in criticism of ESG? Some have talked about it as being perhaps too prescriptive, if I can say it, being too prescriptive, too constraining to management, and potentially hurts shareholder value.
Yeah, I think those are all potentially really valid criticisms. The ESG ratings and analysis has always been precise as well as maybe overly prescriptive. It's a very precise ratings that may not be the right level of precision or the right ratings for every investor. It's a single rating or single set of ratings for a company or for a fund that is used in many different ways. It's sort of a too single solution for all the different use cases that are out there. Beyond that, I think ESG ratings have, they can be very harmful to shareholder value. If a company is rated poorly, that rating is often very powerful. It can drive changes in investments, and we saw with Tesla being booted from the index this last week. It's going to drive some investments going away from Tesla potentially. That can happen at a large scale. For Tesla, it may not matter. They're such a large capitalized company, it may not make a difference. But for other companies and for other shareholder value, it can make a big difference. If a company gets dinged by an ESG ratings provider, that's a single provider's opinion. That may not be. It's definitely not everyone's opinion. And that can have an outsized impact on investments that gets driven to that company.
Yeah, but there's a place for the E, S, and G. I don't know if it belongs all together in one kind of check the box type of approach, right? There's definitely a good part of stock picking is understanding that making sure that the company has good governance and or depending on the industry that it's in, that it takes care of the environment, things of that sort.
Yeah, I think that's a great point. There is a lot of useful data that you can use within ESG ratings and ESG data related to it from a purely financial risk perspective. You can look at good governance or look at its climate-related metrics for the climate risk exposure, or its social-related metrics for social risk exposure. So a lot of things that can be very helpful from a financial performance stock picking perspective. I think you just need to know what you're using and the data that you're using. If you are using it to make decisions, then just be aware of what goes into those ratings or analyses.
Yeah, and data is such an important part too, because it's not consistent across stocks and firms.
Yeah, definitely. Different firms report different information. There's no standardized reporting requirements here in the U.S. yet. There is started to be some more in Europe, and hopefully soon here in the U.S. some more standardized requirements coming out. But so far, there's very little standardized information. A lot of the largest companies will report according to some international frameworks, and that can include similar information from carbon emissions to water withdrawals to waste generated to board diversity, et cetera. So that's often useful. It's just as hard to draw really robust comparisons across large cap, mid cap, small cap, different geographies, different asset classes. So it can be helpful to work with a data provider that does some of that organizing and comparison, as long as you know how that data provider is normalizing or collecting that data.
Yeah, and are companies actually collecting that data on their own? Or are they going to have to go out and take on some new processes and collect new data that they haven't before?
Yeah, most large companies are definitely doing this collection on their own, or there are some third-party services that help them aggregate and collect that and organize that information, definitely. But most corporations do have some process in place, at least if it's a large corporation. Will be ongoing, I think, growth of that internal process. As there's more and more demand for data, this is going to be more of a burden on corporations to do this collection, to report it in a standardized way, to do independent audits of their ESG data, a whole variety of the whole industry built up around that.
Can you talk a little bit about the proposals for standardization? You're talking about some of the SEC proposals, right?
Yeah, I think it's still early days, but I've been hearing more that firms, financial advisor firms, others have been talking with outside auditors about their ESG process. I think the guidance that comes out is going to be related to ESG diligence, to what you as a asset manager or a financial advisor or other financial firm are. What is your process for understanding the ESG-related risk, for doing diligence on your investments or your data directly? Having a really transparent, diligent process in place is, I think, what's going to be the most requested or asked for by the SEC.
Yeah, it's interesting. It's going to be definitely a new world. In Europe, like for investors, they're basically asking investors to fill out I'll call it like an investor profile or investor questionnaire in terms of what they're most interested in, right? Do you see that happening here in the U.S.?
Yeah, I do think something like that will likely be rolled out at some point. In Europe, it's a standard set of indicators or metrics that you as a financial firm have to report on your portfolio, on your holdings, on you as a firm. I think that's a great thing. We need more standardized reporting. It will be some additional burden for financial firms and corporations, but from an ESG and impact perspective, it's so critical to have standardized information, to be able to compare easily and transparently across corporations. It's a challenge today, which is something that Ethos we try to help with, but would love to have more comparable information, easily comparable information that's very helpful for looking at which firms are actually having an impact or actually being responsible with their decisions.
Great. Let's talk about Ethos some more. Maybe you can give me a little bit of the background, the story of yourself and how you came to launch it and when you launched Ethos and got it off the ground.
Yeah, thanks. So my background, I worked in nonprofits here in Minnesota, serving endowments and foundations, doing grant writing, measuring impact of social programs for funders, for endowments, foundations, and others. So come at ESG from an impact measurement perspective. After working in nonprofits, I went to business school and worked as a consultant for large corporations doing data analysis, working with large data sets. So come at Ethos and ESG with a impact measurement and data first perspective. I don't have the financial and investment background. Others on the Ethos team have that. So I consider myself an outsider to the investment industry, but really come at it from an impact first perspective. So founded Ethos in 2019 with the goal of taking this really robust impact first approach to ESG data. And basically what the goal was and what we do is aggregate a lot of ESG and impact related data and make that accessible, transparent, meaningful for investors. So aggregate information like carbon emissions, like environmental fines, patents, employee reviews, waste generated, water withdrawals, a lot of the typical metrics as well as non-typical ESG metrics that try to get at some of the impact question a bit more. So, for example, we developed a metric looking at U.S. Large corporate responses to the killing of George Floyd in 2020. Did they change their business model? Did they what statements did they issue? What did they actually tangibly change? Things like that, where we're trying to respond and trying to develop additional information to help get at this impact question. We provide the services, provide software and data to financial advisors to use with their clients, to asset managers to use in fund construction and marketing materials, to asset owners to use in their portfolio analysis, as well as to other tech platforms.
And as well to individual investors. You can go on your website and put in your portfolio, put in a stock, and find out how it's rated, right?
Yeah, definitely. Something we feel really strongly about is the mission of enabling everyday investors to understand the impact of a fund or a stock that they're considering becoming involved with. So a lot of that information is freely available on our site. You can find information about a potential company or fund you're looking at.
Can you talk a little bit more about how you measure impact? And I don't know if you have an example, I mean, in terms of some of the data that you capture, are you comparing the volume of impact or whatever it is, or water reclamation or something for one company versus another company and measuring impact that way? Or I don't know, can you give me a little bit more concrete example of how you measure impact? Do you measure financial impact, or is it really just more impact on a particular issue?
Yeah, we do look at financial risk and financial impact, but our primary focus is the latter point you made about impact on a particular issue or cause. Often the metrics will be the same if you're looking at impact or risk, for example, with oil and gas companies, their carbon emissions and how they've reduced their carbon emissions over time, or their carbon intensity. Those metrics are relevant both from a climate risk perspective and an impact perspective. If an oil and gas company is transitioning away from fossil fuels, that can have a huge impact, but also can be a significant risk. When we think about impact, we define specific causes that we're looking at, from climate action to racial justice to gender equality, mental health, a whole variety of causes, about 45 core causes that an investor might care about. Each cause we then look at what are the available and really relevant data points that could point to impact that a company might have on that cause. So for gender equality, for example, it's a lot of policies that a company might have to promote women within their company, some gender diversity stats, some of the policies for paternity leave, a lot of their policies and practices that would relate to how are they treating women, would include things like any controversies related to gender equality at the company, things that we believe are both credible and relevant and quality data points that are available that also get to what is this company's impact on this cause. For climate action, for example, it's going to include things like carbon emissions, but also climate solutions. Is this company developing a climate solution? So a lot of the like solar and wind, for example, are clear examples of developing climate solutions that are going to contribute to a better climate solution.
So, I noticed just playing around your website, you can put in what you are most interested in, what issues you're most interested in. So if you're really interested in social justice, is it possible that you could end up with a company that rates really well in social justice, but overall impact score maybe not so great?
Yeah, definitely. It's just the case with ESG ratings that you see out there. You see a single rating often that encompasses a whole variety of things beneath that rating. So we've tried to disaggregate that rating. So if you say I care about social justice issues, then your information and ratings and analysis on Ethos is going to focus on those issues, and you'll see information related to that. You can still find the other ratings related to climate or to other issues of governance, other things, and we would just show that distinction between what you said is important to you. I think that's an overall trend that ESG is moving towards and needs to move towards, is tailoring to things that are important to people.
And how do you define financial materiality? Do you have a prescribed framework with which you follow?
Yeah, we started with some widely used public frameworks and developed our own. We're looking at it a bit of the inverse. So impact materiality is what we call it, where we're saying what causes or issues does this industry have a material impact on. It is often the same as financial materiality, where if you're an oil and gas company, climate change is very financially material for you, but you're also having a very material impact on climate action. where software companies, for example, their impact material causes would be more social related, mental health, for example, things like that.
What is I don't know if you know this, but the demographic of your users and today? I'm just kind of curious whether if you know it from an age level or if you're working more with financial professionals or individual investors.
Yeah, it's as you might guess, skews toward younger advisors and investors, but there's quite a few. It's not an extreme skew towards that direction. There are plenty of advisors and clients of all ages and all demographics who are interested in ESG. I would divide the investor universe into a few areas. One that is on the leading edge of impact. They're sort of passionate about impact, have been passionate about impact for a while, and our core customers are people who have really been in the ESG and impact space. There's two more of a reactive or a practical group that is either sees the financial risk related to ESG and wants to incorporate some ESG into their investment process from a risk perspective, or they're just maybe newer to thinking about impact or thinking about alignment of money with their values and just starting to learn more about this. And I would say that's the broadest part of the market. And then there is people who are very anti-ESG or very hostile to ESG and who see it as not relevant for financial consideration or shouldn't be part of the investment process at all.
Yeah. Well, I go back and forth on that. I mean, like ESG quotes ESG as a term. I'll call it a marketing term that the financial industry has kind of perpetuated. I think is perhaps a fad, but I think the intent is long lasting. Is definitely a trend, and I don't know. That's why I really love your story and the idea that you're approaching it from the impact side of things, because I think that is what people are thinking they're trying to do with their money, and you can tie that back to some real world effects.
Yeah, investments are, just come back to the analogy of like voting, and people are realizing that they can have a real impact through their investment decisions and through where their money is being used. It's, I think, a long-term, probably longer-term trend to look at really this closer alignment of values with money and impact of your investments. It's still nascent, but I agree people are rethinking sort of corporate purpose long-term, and is corporate purpose and investment purpose really just about shareholder value, or can we include some other social value elements in there, environmental values? I think that's a longer-term trend, but hopefully will continue to grow.
So since this is a podcast about trends, and we've been talking about one big one today with impact and ESG, what is one long-term trend you see playing out over the next year or several years? It can be about what we just talked about or anything else top of mind.
Yeah, well, I'm going to stick with the script a little bit. You mentioned something like $1 out of every $3 currently has a sustainable related lens to it in the U.S., I believe. And I see that amount growing. When you define what is a sustainable lens to investing, that can mean risk or impact, a whole variety of things. But I think that number is going to continue to grow tremendously, despite all the criticism and the downfall or the downsides of ESG. There is still a lot of value, and people see the value in understanding either from a risk or an impact perspective. I see that number going up. I would love to see that $1 out of every $2 in the next few years has some sustainable or ESG lens to it. That obviously it means many different things, but I do see that number growing, and it's really hopeful thing for me to see this, all the difficult things related to climate change and social justice that I feel very passionately about. I love seeing increased interest in the financial world towards addressing that.
Cool. All right. So let's do trend or fads, our speed round, and I'll try just 2 to 3 different concepts and get your quick take. CEO retention bonuses, trend or fad?
That's a good one. I think that is a trend that's going to continue.
NFTs, trend or fad?
I'm going to go with fad on that one.
Data privacy, trend or fad?
That is a trend. It's very important.
Space investing, trend or fad?
Very long-term trend. I think it's initially a fad, but a trend over time.
Excellent. Well, Luke, this is awesome. I really appreciate the conversation.
Yeah, thank you. I really appreciate it. To be in here, great to talk with you and such an important topic. So thank you very much.
Absolutely. What's the best way for people to learn more about you and Ethos?
Yeah, please go to ethosesg.com or reach out to me, Luke at ethosesg.com. Would love to talk with anyone.
Fantastic. Thanks again, and thank you for tuning in to another episode of Trends with Benefits.